kicking us. Yeah, thanks for kicking us off. You did a beautiful job, and thank you for the raving reviews. I think you deserve a lot of accolades as well for finding real estate as young as you did and taking it all on while you're a nurse practitioner. I mean, that's a lot. And so you're light years ahead of most of us when we find real estate. We're later in life. So really happy and proud of you.
Thank you.
But as she mentioned, I'm Jennifer Barner. I have been in real estate for 8 years. I started out as a Rich Dad student, and then after a year, found that I couldn't scale quick enough to make up for the years that I didn't know about real estate. So I finally found multifamily and quickly learned that I could invest in real estate using my IRA. And it's something that financial advisors don't want you to know because you're taking money out of their pocket. But Corey and his company have made it super easy to invest in IRAs, or excuse me, invest in real estate, leveraging their help. And so I use a custodian. Unfortunately, it's not Advanta, but when I started working with people that were getting their investments funded really quickly, I inquired, who are you using as your custodian? And they always came back and said Advanta. And I said, I'm going to start telling everybody Advanta because they make it super easy to get your deal done. And they also assign a personal, a personal service advisor to your account. So a little bit more about me. I am now a general partner on over 1,000 doors. And I'm a limited partner in over 2,000 doors. So I've been able to go full cycle on a deal now and have 11 other deals that I'm involved in. But again, using your IRA is one of the best ways to grow your net worth. And so with that, let's turn it over to you, Corey, and share how people can get started using their IRA to create, wealth for them and their families.
Awesome. Excuse me. Well, thank you, Allie and Jennifer, for having me on and kind of the networking that comes into us all coming together. Very happy to be here to share some of my experience. Really have had about the same time in the retirement investing industry that Jennifer has had in real estate. So my entire professional career has always been in banking and finance. I started even in high school having an interest in taking accounting electives and business management electives and entrepreneurship. Put myself through college as a business major with a management degree and also pursuing accounting. I decided as a senior in college, I do not want to be an accountant. So I stopped a few credits away from a bachelor's there. But basically always working in banking and finance. I did a little bit of entrepreneurship after college. And then it just wasn't working out for what I needed and what I was looking for. And I found Advanta IRA. I've been with Advanta for about 7 years now. And for the first chunk of that time, I was a client account manager, the role that Jennifer referenced, where I really just had a roster of clients assigned to me. I would take in their calls, answer all of their questions, and help them get their investments processed. So basically, clients would call with all different types of deals, and they just need to talk through what the IRS allows you to do and then actually execute the investment based on what those rules are. So that was my day job for about 5 years. And then about 3 years ago, I moved up to Western North Carolina, where I live now, from our main office headquarter in Florida. And they switched me based on my knowledge and my experience and some of the other things that I have going in my career to this networking and education based role. So my day job now is really doing these types of presentations, getting out there and networking, and really just expanding the knowledge that people don't have about self-directed investing. So Advanta IRA is a mid-size self-directed administrator. We've been around for 20 years right now. This is our 20th year, and we have about 10,000 active clients and just over $2.5 billion in assets under management. All of our clients' funds that are not in an investment are insured in basic trust bank accounts up to FDIC limits. So you don't have to worry what's going to happen to your money if you don't have it in a specific deal. And if you have it in a specific deal, that's up to you to have picked that deal and know the risk involved with the investment. So we'll get into that a little bit more, but just your funds are secure when they're not actively invested. And we pair each client with that account manager. It's not something a lot of companies in our industry do, but we do that so that you as a self-directed investor have the ability to just know who you're speaking with. When you call those larger fiduciaries, maybe you have a rep, but sometimes you're speaking with his assistant, or if you don't even have a rep, you're calling a big wire center and having to explain what you want to do with your retirement money or your finances to a new person every time you reach out. So that's a factor that we have where we don't want our clients to have that insecurity or instability feeling. They get comfortable with their account manager. Again, I was in that role for 5 years. So at a certain point, I knew a lot of my clients that would reach out regularly. We'd have nice conversations. And really, I knew what they were wanting whenever they called, even before they asked me sometimes. So I do have to provide a disclaimer. This is all educational knowledge and experience that we're providing. We always implore you to do your own due diligence. So always seek your own CPAs, attorneys, financial advisors. We can refer you to people in those various fields, but we do not provide any tax, legal, or financial advice. We are strictly experts in what the IRS rules and regulations are relative to retirement account investing. And that's kind of our lane. That's what we're here to provide as a resource and as an expertise. And it's up to the self-direct account holder to pretty much bring the other pieces to the table or coordinate the other pieces. So my agenda today is really just to say what a self-direct account is and the vast abilities you have to use it in different ways, show you how easy it is to fund these types of accounts and how simple it actually is from the day I want to start an application to the day I'm able to make my first investment. I've got a few case studies I'll go over. And then, as Jennifer and Ali said, we'll cover some Q&A at the end too. I do want to hear what you guys have to say. I'm sure I'll bring some things up. I might answer your questions as I'm going through, but anything I don't specifically answer, please share with me and I'm happy to answer it. If I can't answer it, I'm very honest about that too. I'll tell you what my thought is and how or what I can bring a better resource when that comes to play. So a lot of people haven't even heard that self-directed retirement accounts exist. Again, as Jennifer alluded to, the fiduciaries or financial advisors out there have a vested interest in you thinking that your money is safer or better invested at their expertise. And they're not guaranteeing you anything except the fact that they're going to charge you either points on what they earn or points period or a flat rate. And then they say, oh, we hope to make 6 to 8%, maybe 10% for you, but we can't guarantee anything. So aside from that, a self-directed account is a way for you to actually take control of all that money. The US retirement industry right now has about $40 trillion in it. And of that 40 trillion, 4% or about 1.5 trillion is being self-directed. The rest of the money is in those fiduciary type accounts. So really, again, expanding the knowledge and information that self-directed investing even exists is a real backbone of what Advanta IRA tries to do. We put out a lot of educational content, and I do a lot of networking just to shout from the rooftops. This thing is here. You can do it. It's always been here. People just don't want you to know about it. So really, what is a self-directed IRA? It's an IRA account where the custodian or administrator allows you to follow the IRS's rules and otherwise does not tell you what you can and cannot invest into. So asset classes, I know we're here to really hyper focus on real estate, but just in general, for your broad understanding, you can invest into lending, hard money lending, private loans to either a secured or an unsecured capacity where you have a lien on an item to go claim if the borrower defaults. That's an asset class you can have in your retirement account. Real estate in many different functions and factors. So I'll cover real estate more specifically in a few slides. But you can also hold precious metals, foreign currencies. You can invest into a movie project, any kind of limited partnership deal. I've seen clients invest into their local coffee shop, breweries. It's a lot of different things you can hold. It's easier to actually tell you what the IRS doesn't let you hold, which I'm going to do in a few slides as well. So the types of plans that can be self-directed. A lot of people are probably familiar with their traditional and Roth IRAs. Those are the most common IRA products. Those are not tied to any specific employment. Anyone in the US can have a IRA, whether it's traditional or Roth. They just have to be able to show that they have ordinary earned income or W-2 income to contribute into that plan. So those plans can be self-directed. For small business owners, people that are self-employed or maybe only have a limited number of employees, there are SEP, simple and solo 401k plans that have a little bit higher annual contribution limit than the traditional and Roth do, a little bit different rules and regulations, but nonetheless, they're still tax sheltered vehicles that you can put money into and make these types of investments. And then we also have health savings and education savings accounts. So a health savings account is really for someone that has a high deductible health policy, or HDHP. And then education savings accounts are also known as a Coverdell education savings account. It's a plan where you can put money aside in a tax deferred capacity, and that money can be pulled out tax free when used for qualifying educational expenses for young ones. Those accounts can carry that person until they even reach their master's degree and postgraduate studies. And then once they're done using it, it can be handed off or beneficiary assigned to another family member. So if you still have money in that account after your loved one, specifically your child maybe is out of school, you can hand it off to another qualifying relative. So that's a really great thing. And again, this is tax sheltered money. It's money that you're either getting a tax deferral on now, or you're paying the taxes on now and letting grow completely tax free, which is the Roth component or Roth side of it. So why do people choose to self-direct? The three main reasons we see are that people are already doing some sort of investing. They're already active real estate investors, and then find out, oh, self-directed investing even exists. I've already been doing this thing. I learned how to make money by doing this thing. Why am I not doing it with my tax sheltered money? Some people see it as a diversification play when they're not so comfortable with the fluctuations of the stock market. Over the past year or 2 years, really, there's been more downturns than upturns in the stock market, which lead people to either say, okay, I'm going to pull a chunk out and put it into these other types of strategies, or some people are just completely done with those types of accounts. And then the tax benefit, again, you're growing your money, either tax deferred, where you're getting a write-off when you put the money into the account, which is a benefit to a lot of people, or you're paying the taxes now on that money and letting it grow for your investment life completely tax-free. For example, if I put $6,000 into my Roth IRA today, and I'm in my early 30s, and I invest it for the next 30 years, if I pay tax on that 6,000 and put it into a Roth account, I can grow it at whatever multiple for as long as I need to, and then never have to pay taxes on the 30,000, 40,000, whatever that turns into, that original 6,000 I put into the Roth account. So great tax benefits. When we're talking about real estate investing, and you actually are taking down a physical property, there are no capital gains to be paid when you sell the deal. So again, with real estate specifically, kind of hyper focusing, which I'll do a little bit further later, there's some additional benefits for those investors. So how to get these plans funded or started? The application itself only takes about 15 minutes. It's 6 pages, very simple and straightforward. But getting the account funded is where a lot of people are like, oh, thinking it's either going to create a tax consequence or be a long drawn out process. And it's actually really sweet and simple. If you're moving your money from an existing IRA account, let's just say you have a managed IRA or a Roth IRA and you want to start self-directing, you just fill out a transfer request form with the receiving company, the company you want to receive the money. They send it to the company that's currently holding your money. And that process is usually facilitated within about 3 to 5 days, roughly, for some custodians. Some of them take a little bit longer. So they each have protocols. And part of my job is to speak with the clients and the deal syndicators and make sure everyone's got a reasonable expectation and understanding of how long it's going to take to get that money over. There are great custodians that are fast, and there are some that drag their feet. I mean, it does happen in the industry. So sometimes they require original paperwork. Sometimes they require a medallion guarantee, which is a notary in the finance world. Sometimes they just require a fax with a signature. But nonetheless, it's really relatively quick and takes about a week to do a custodian to custodian transfer. The other way money moves into these self-direct accounts is called a rollover. Most of the time, probably 90 to 95% of the time, specifically a direct rollover, meaning you have an employer-sponsored plan like a 401k or a 403b or a thrift savings plan or a 457, any plan maybe from a job that you have already left, is money that you can pull out of that plan and move to a self-direct account with no tax consequence and no liability. You just have to reach out to them and say, hey, I'd love to draw this money out. by way of what's called a distribution for rollover. There is tax reporting when you do this. The distribution is reported on Form 1099 to the IRS by the company you're pulling the money out of. But as long as you roll it into a qualifying plan, that is reported on Form 5498. And those dollar amounts, as long as they match like a seesaw, you do not have any tax liability. If you withheld any certain amount, that's where we leave the direct rollover side and just go into a rollover, because you do have the ability to hold that money for up to 60 days and then deposit it into a qualifying plan. So there's called a 60-day rollover or a bridge rollover. Some people actually do that so that they can use that money for a personal purpose and then put it back into a qualifying plan. And when that happens, if you don't end up putting all the money back into a qualifying plan, you will show a tax consequence for whatever is either left out. Or again, if you choose to do that Roth conversion I referenced earlier, you're foregoing the tax write-off, but you're paying the taxes on that money to let it go into a plan that it can grow completely tax-free and will never be taxed again for that matter. So the rollover process takes a little bit longer because in most cases, the distribution is only able to be processed with a check. They will not wire and they will not ACH in about 80 to 90% of cases. So it takes a little bit longer because you're talking about sending a request to a company, having them mail a check out, and then the deposit hold relative to that check when the custodian receives it. So I hinted towards this earlier, the rules behind self-directed investing. As I said, it's easier to tell you what cannot invest into than to tell you the various things you can invest into. So you're not able to invest your IRA account into a life insurance policy or what the IRS would consider subjective assets, anything that has a subjective value where I may think it's worth something and my neighbor or a complete stranger may think it's worth a completely different amount. I always use this example. There's a house, I live in the mountains, there's a house up the hill from me, and the guy's got an old, rusty, like probably mid-70s Corvette in his driveway. And I think it's an eyesore, and I would love it not to be there in this guy's driveway. But surely he thinks with a little elbow grease, it's probably worth a lot more than I would ever pay for it. That's an asset that the IRS doesn't want to see you hold in your retirement account. But outside of that, again, as long as it's not a collectible or a hard to value asset or a life insurance policy, there's a way that you can hold it in your retirement account. You just need to speak with experts like us so that we can hear what you want to do, apply our knowledge of the IRS rules to that, and then provide you the detail and instruction as to how to accomplish that goal that you have. The other way the IRS restricts what you use your retirement accounts for is by labeling certain individuals relative to you as disqualified persons. Now, these disqualified persons are specifically yourself and your spouse, your children and your parents, or anyone else on that family tree. This does not include sisters, aunts, uncles, cousins. This is only your parents, your grandparents, your great-grandparents, your children, your grandchildren, your great-grandchildren, yourself, your spouse, and any business entity that any of those individuals control 50% or more stake in. So any entities that those individuals own are considered disqualified from dealing with your retirement account. So I can't buy a house from my father. I can't own a house and let my son be the tenant paying rent to my retirement account. Those are kind of examples of disqualified persons rules and the transactions that would be red flagged. Aside from that, you can partner with disqualified persons. So you are allowed to go buy a house and have your retirement account and your spouse's retirement account split ownership in that property, or even you as an individual and your retirement account for that matter, split ownership in that property. There is a little bit of caveat with syndication investing. If the syndication is put together and a disqualified person to you or yourself are on the general partnership team, there's a little bit of nuance here. There is no real black and white rule from the IRS's standpoint, but if the general partner that's a disqualified person is either 50% or more controlling stake as a GP and or makes day-to-day decisions on behalf of that syndication, you should not invest your retirement account into that deal. If those factors are not both met, so if the GP that's a disqualified person is less than 50% GP stake or ownership and does not make day-to-day decisions, they're serving some other role as a general partner, then Advanta would not stop you from making that investment, but we would, in hearing that action plan and strategy, implore that client to go seek legal counsel and make sure if the event of an audit ever occurred in the future, that you have some sort of legal backing to protect yourself or protect your investment in that case scenario. So again, that's part of self-direction. We're not here to handcuff what you do and don't do. We're here to interpret the IRS rules to the best of our ability for your knowledge and really help you do exactly what you want to. Real estate asset classes. I told you I would get into those earlier. Again, we're talking anything real estate. You can own a single family home. You can own a fix and flip. You can own multifamily as a limited partner, or own a duplex or a multiplex unit as a actual owner. Your IRA account or 401k account is the deed of title in the county records as the owner. There's also syndication investing, which we'll get into specifically just in my next slide, which is the start of our case studies. But really, again, tax deed and lien investing as well. I just saw my screen. For those that are just getting started with retirement accounts, that's a great way to get into the real estate asset class, where you may only have your first $5,000 or $6,000, your first year or two of contributions into an IRA. And the way tax deed and lien investing works, if you hit a home run with a deal like that, you can, in theory, put up a few $1,000s and end up owning the deed of title to a physical piece of property. What you do with it then is, completely your own discretion. But it's a scenario that could work out for a lot of people that are really just trying to get their feet wet and maybe already have experience in that avenue. All right, so jumping into our case studies, I'm going to cover a few different asset classes in real estate and how an investment would look if you went into them, starting with syndication investing with the real estate. So I've got Abel and John. We've got Abel, who has a retirement account. It's currently with a managed custodian, and he's learning about real estate investing and meets John, who's a syndicator, has a public offering to provide to the people, or a private offering, I'm sorry. And they go over the prospectus and the memorandum and everything, does thorough due diligence. Abel decides he does want to make the investment. So he needs to set up a self-direct account, get the money moved over from his current custodian, and get the investment paperwork approved before whatever deadline is set. With, again, a reasonable expectation here, this should be about a week and a half to 2 weeks. We can get it done in as fast as 7 for a brand new, never established account. But if Abel had a self-directed account already, this could be done within 2 days, roughly 24 hours. Again, a comfortable estimate, 2 days. So the process works. The account gets set up, the transfer request gets sent over to that other custodian. While we're waiting on that money to come in, John provides the PPM or the subscription documents. We make sure those subscription documents are filled out in Abel's name, so the name of his retirement account, not him as an individual, and the tax ID number for the retirement account, not
I'm not
Abel's
grossed out
number.
but it's pretty stupid. Do you want to?
Had to mute someone, sorry.
Oh, no worries. Yeah. So in this example, the investment paperwork's all approved, the deal's executed, and then moving forward, going full cycle on this syndication deal, there was an 8% preferred return, reasonable, possible. So the $50,000 deal generated just $20,000 there over the course of 5 years. And then when the project was refinanced, a lump sum of $65,000 was paid out. So over a 5-year time frame, again, these are rounded numbers. This is for educational purposes. This investor, Abel, was actually able to generate $35,000 of either tax deferred or completely tax free, if it was made in a Roth account, income with his retirement account, all passive income that was generated. So the next case study is actually buying a physical piece of real estate. There are some nuances here that I'll go into that I want to make sure I cover and everyone understands, in case you are a flipper or someone looking to put together a rental portfolio. So we've got John, who has $150,000 in an old employer plan, and he decides he finds a distressed property up the road he'd like to invest into. So he does a rollover out of that employer plan, gets the self-direct account set up, puts an offer in on the property in the name of that retirement account, and gets the process started to do a cash deal. So once the property is actually held in the retirement account, it is completely the self-direct client's responsibility to pick who they're going to rent to or to coordinate the vendors that are going to do the flip work. John himself cannot do the actual labor on the property. That's something I'll cover a little bit more thoroughly on the next slide. But renting the property and coming up with all the terms is your discretion as the account holder. You can seek a property manager. Obviously, it's up to your retirement account in that capacity to pay the property manager, which usually they'll deduct whatever their costs are, and then they'll send residuals back to the self-direct account on the back end. So that's completely the self-direct client's decision. But again, I just mentioned there, you can't do your own sweat equity or labor on a property owned by your retirement account. This is a callback to the disqualified persons rules earlier. You as a disqualified person can't generate this benefit for your retirement account that you would otherwise need to go pay a handyman or a laborer to do. So not even changing light bulbs from the IRS's standpoint, or painting the walls or changing flooring, that all has to be done. Doesn't have to be a licensed certified plumber or electrician. You can just use your discretion and just go to a handyman, but it legally should not be yourself or your disqualified persons. Paying bills all need to flow in and out of this retirement account. So with our clients, they have an online portal they could always log into 24/7 and submit any payment requests. A lot of times we'll have authorizations on file. So their recurring vendors just send the invoice straight to Advanta and we pay it automatically upon receipt. We're talking for like utilities and things like that. So it really becomes a hands-off experience for the account holder when they've got their account set up and running. Or again, if a property manager is in play, then that's a separate way to handle it as well. So in my case study here, I had, remember, a client that had $150,000 in an account and went and bought a $100,000 property. It was rented for $1,250 for 2 years. That's $30,000 of income. And then the property was sold for $150,000, which netted a $50,000 profit. So that's $80,000 in total profit realized that's either tax deferred, doesn't have to be paid until later when this money is distributed out of the retirement account, or completely tax-free. Now, in perspective, the reason I said he had $150,000 and bought a $100,000 property, if you're a flipper, there's major expenses that need to be done. That all has to be paid out of the retirement account. So you don't want to go buy a $150,000 property if you have $150,000. You need to give yourself a cushion, because if an expense does come up and you can't afford it with your retirement account, your hands are tied. You're really limited to how you can actually cover that expense, and you may be very vulnerable. But now, in this case, that money can be reinvested however that client wants. And then my final case study, which I'll go over a little bit quicker just to kind of get the principle out, is what's called checkbook control, or the single member LLC. A lot of people also refer to these as real estate LLCs or real estate IRAs. In itself, it's a principle where you are establishing an LLC that is wholly owned by your retirement account. Therefore, it carries the shelter from a tax perspective of the retirement account. And the manager is yourself and or anyone else that you want to appoint to be the manager. So you end up getting a checkbook or a debit card access to your own retirement funds, with the expectation that you're using them within the IRS rules and regulations. But again, there's a little bit more onus on you because you have that control and that power, and we're not overseeing all of your transactions and helping you through them, that you make sure you're doing things within the right rules. So in this scenario, the person would set up a self-direct account, and then in the process of getting the money moved over, start working on the LLC. They'll have to register it within the state of their choice. They'll have to register it with the IRS to get a tax ID number, and then they'll have to go to a financial institution of their choice and set up a bank account. Just a basic business checking account is exactly what you're looking for in the name of the LLC. That is something that I've worked, as I mentioned earlier, my professional history, I've worked in banks and been a bank teller and been on the banking side. You really just need to walk into a bank with your articles of organization and your operating agreement and say, hey, I'm the manager of this LLC. I'd like to open a bank account in this LLC's name. When you start to say, I've got this IRA and I need an LLC for this, then they're not as eloquent in self-direction. Again, not a lot of people even know about this. and you get tied up with a bank representative trying to sell you on their IRA product. So it's my personal expertise and experience. Just give them as basic of details as they would need. The more detail you give them, or the more you peel the onion back of this is a retirement account LLC, the more you're going to get tied up with some poor bank center employee that's really trying to close a deal on a new retirement account that you don't even need. But it's that easy to get these things set up. Once you have that set up, again, you can do whatever you want with the money, as long as it's within IRS rules. We're not a big brother on that bank account, so in theory, you could do something prohibited. If you ever think you're going to do something prohibited, that's why we have client account managers and resources. You should contact someone at your retirement custodian and really try to talk through those things. I had an example, a client contacted me and made a reference to something that he did negligently. He didn't know otherwise, but he did it already. And what the IRS really looks at in those scenarios is at the point that you determine that you have done something, that you immediately try to unwind whatever that is as effectively and efficiently as possible. And it's not like they're going after to audit you and to rip your retirement account and your benefits away from you. So again, just keep an open door or line with your administrator and with the rules if you're not comfortable in what you're planning to use the self-direct LLC to invest into. But for the most part, this makes it easier for people to jump into syndication deals faster, close on physical real estate faster, go to an actual auction and do tax deed and lien investing faster than waiting for normal business hours to contact your account administrator and do the transaction through the actual administrator. If the rules I brought up to you earlier with disqualified persons are coming up and you're thinking this LLC, but I'm the manager, but you said I can't control things like that, that's perfectly common. A lot of people bring that up and say it sounds conflicting, but there is case law and case study that support you can do this. The 1996 Swanson versus Commissioner case, really, Mr. Swanson basically was found and red flagged to have done prohibited behavior by serving as his IRA's LLC's manager, and he fought that in court and actually won, indicating that yes, you are allowed to serve as the manager. You're not doing any sweat equity or manual labor. You're just coordinating the usage of your retirement account at your discretion, but you can't compensate yourself for doing that. You can't go travel a property. For those of you that were here earlier when Allie was mentioning, you know, her father's doing a lot of investing and likes to be boots on the ground. You can be boots on the ground, but you can't pay for your flight to get there and pay for a rental car and things like that. So that's kind of more of the side that the TL Ellis tax court memo clarified later in 2013 was that you can't compensate yourself, whether it be a salary or by covering certain expenses, because you're the manager of your IRA's LLC. Again, the IRS really is looking here to create a future benefit for you with your retirement account. And a key term that they use is a current benefit of your future earnings or a future benefit to your current self. You're not supposed to kind of pull on both sides of the fence there. So that's kind of what the IRS is looking for. Again, I'm happy to explain and help you more thoroughly with questions as it relates to that. It's really quick to set up an account. I think I said it earlier. It takes about 15 minutes or so to complete a DocuSign application. When you're doing a transfer request, we do need you to print one page and sign it, because no company is going to move your money by looking at a digital signature that anyone could sign on to a DocuSign account and generate. So that's really the main legwork with our application. It otherwise takes people 15 minutes. The account set up, usually funded and ready to make your first investment within about 7 to 10 days. And I'm happy to help anyone through that whole process to get that started and spun up. Or if you know other people that may be interested, you can put them in touch with me as well. As far as other educational content, we do, as I said earlier, put out a lot of educational content. We typically do 2 educational webinars a week. I had Jennifer as a guest last week, I believe, as one of my guests. All those live on our YouTube page. So Advanta IRA on YouTube, you can find a back catalog of probably 10 plus years of educational webinars. We cover the same topics relatively frequently, but we bring on new guests to spice things up and kind of change the way we're presenting these things. And we have a podcast as well called the Alternative Investing Advantage Podcast. My colleague Alex Purdy hosts that. And it's a really great resource if you want to hear other kind of not so educationally based conversation with industry experts. Here's my contact information again for a moment. And if Jennifer and Allie want to unmute, I'm happy to start the Q&A if you wonderful ladies would like to start facilitating that.
Yeah, definitely. Thank you so much, Corey. I really appreciate all your knowledge. I learned some things from this presentation that I didn't know, so that I didn't already know. So thank you. I do have a question. We are going to open it up for anyone who has questions. I do have a question because I told Corey before this call that I need to set up my own SD IRA. So he did tell me, like he did in this presentation, that I have to fill out an application. And then from there, what does that process look like with me contributing to that account? Is it like a buy? I've never had a 401k ever. I had one, and it was through one of my employers, and I didn't really know too much about it. So I don't even know what that process looks like, to be honest.
Okay, so we're going to walk through this for the audience. So you're kind of our guinea pig here to show everyone what this real conversation would have been like tomorrow, but we'll just do it right now. So you just mentioned you had a previous employer plan. Do you know if that still exists? Did you already cash it out? Do you know who to contact to get a hold of them to do that distribution I referred to earlier?
Yeah, I cashed it out during COVID, actually, when they
Okay.
had that, like, you could take it out with no penalty or something like that. Yeah, it was
Okay.
like, I think it was like 10,000 in there when I cashed it out. That was it.
So the fact that you brought up you did it during the COVID kind of grace period, or what you're referring to there for the audience is the CARES Act. I believe we're still at the tail end if you wanted to and had the resource that you could put that money back into a qualifying plan. So kind of get the tax benefit back. I'm not 100% sure. Again, this goes back to a tax advice standpoint. But there's potential for you to get that money back into a qualifying plan and use that for self-directed purposes. So that in itself is something I would either, like I said, coordinate the call with you to that plan administrator, or in your case, I think speaking to someone to verify the CARES Act and with the date that you actually took that distribution, are you still eligible to get it back in if you wanted to? That's its own kind of ball of worms. But separately, if that is not an option, or we're talking about a new account with a new money contribution, you typically have to have ordinary earned income, as I mentioned earlier, unless you're someone that qualifies for the solo 401k plan, where we're not necessarily looking for W-2 wage income. We're looking for income that you pay self-employment income tax on. So again, you mentioned you have a day job in the medical profession, but you're also getting into real estate investing. So who knows if you've got your own real estate LLC, or if you're starting to generate, substantial income as a real estate investor. Is another conversation with your CPA or tax preparer. Is it worth it to set any of that income up as self-employment income so that I can have a solo 401k plan and start generating tax deferred or tax-free benefits from that? I can't make those answers, and that's not what I'm here for. I'm here to at least bring up the idea and the concept and kind of prompt that conversation to be had. So one leg there is maybe you're a good candidate for the solo K plan, but if not, we still fall back on the traditional or the Roth IRA. So as long as you have W-2 wage income, if you're under age 50, you can contribute $6,500 into that plan for calendar year 2023. If you're over age 50, you can contribute $7,500, so one extra $1,000. In a standard kind of format, the IRS has kind of been bumping that number up about $500 per year as a regular occurrence until COVID happened. Then they kind of paused it, but they just this past year bumped it up 500. So maybe they're going to keep bumping it up. So next year it'll be 7,000 for under 50 and 8,000 for over 50. I'm not 100% sure off the top of my head if that is already in play or not. So it is kind of just something to keep an eye on, or just double check. But anyway, if you have the income, then you can make the contribution. You just cut a check or send a wire to the new account you have established. We can have wire or ACH instructions generated for you within 24 hours of opening your account, or within 24 hours of you submitting the application. Your account will be opened and we can have the instructions out to you. Or you just cut a check payable to your new account. So in this case, you would cut a check to Advanta IRA for the benefit of Allie Fitzmaurice. And when we receive it, we deposit it. We have a deposit coupon. It's really simple. It's part of the application. You just say, this is a 2023 contribution. This is 6,000 and I want it to go into a traditional or a Roth account. So it's as simple as that. The funds, once they hit the account, if it's an ACH or a wire, they're available immediately. If it's a check, we do have a standard 10 calendar day deposit hold for any check we receive. That could be a $5 check. It could be a $5 million check. It's just a standard protocol we have. Cashier's checks or money orders have a 5-day hold, so it's a little bit shorter for those type of kind of certified funds, but other checks, doesn't matter how big or how small, 10 calendar days from the day you can start using it. And actually, one thing I don't think I said earlier, with a brand new established IRA account, this is an IRS rule. You have to wait 7 days before you're allowed to make your first investment. It's called the IRS's right of rescission period. It really stemmed from having people set up accounts, make investments, and then say, oh, I didn't want to do that like 3 or 4 days later. And when you've already invested, as everyone's aware, that you can't pull that exact dollar amount out. You can't say, oh, I made a $20,000 investment and now it's worth $18,957, but I need my 20 back because I didn't want to do it in the first place. So that's why the IRS has a 7-day rule. But that really helps us as an administrator. Within those 7 days, we're getting the money request out there. We're getting the investment paperwork for the deal started if the client already knows exactly what they want to do, and or we're educating the client on what they can do with the funds so that they're ready to rock and roll after that 7th day. Again, the reasonable expectation I tell all new clients or all potential clients is expect to give yourself about 2 weeks from when you need the deal to be funded. And that's a reasonable expectation. Most of the time, we're able to beat that. Sometimes it may be a little bit longer, but in those cases, there's something that's, like I said, the other custodian is requiring some extra things, or, there's some due diligence with the actual deal that the client's, still working out.
Okay, awesome. Thank you. And my follow-up to that is, and then, so I have my account funded, and say I have now $50,000 I've been contributing, year after year. And now Jennifer has a multifamily deal, an apartment building, and I want to invest as a limited partner or an LP as a passive investor. Then I would come to my custodian and say, I want to invest X amount of money into this deal. Is that how that kind of works?
Pretty much, yeah. So you would either make the introduction. So let's just say Jennifer and I didn't know each other. You would either make the introduction and say, hey, Corey, my account administrator, I found Jennifer. She's got this great deal. I want to make the investment. Then the account manager's job is to coordinate with Jennifer, receive the investment paperwork if you didn't forward that to begin with in the initial email. Send that paperwork back to you via DocuSign to approve once it's filled out in the name of your retirement account. Basically, we're collecting your authorization that you're telling us to pull the trigger on funding this deal in the name of your retirement account. All in all, that is really something that can be facilitated within 24 to 48 hours. So if you, as you said, have the account and you're not still in that 7-day right of rescission period, you've already had the account for a few years, you've been contributing to it and building up to having a balance to do a syndication investment, because a lot of us are aware limited partnership deals, there's usually a minimum threshold of maybe 25,000, sometimes 50,000 is a reasonable expectation there. We can get that deal turned around really quick, even quicker if we have a trusted partner like Jennifer that has a lot of clients with us and we've already got the paperwork in hand. Allie may be the 10th person that's reached out and said, hey, I'm joining Jennifer's deal. We are locked and loaded with that paperwork to get it back to you and turned around. So those types of things kind of build on each other and help out as well, but it's really quick.
Awesome. Thank you so much. Thank you.
Mm-hmm.
Yeah, you did a beautiful job walking through that. I'm curious, does Allie sign in that scenario, the paperwork, or do you sign on her behalf for that, authorizing that investment?
Yeah, so that's a great question. That is kind of the nature of what we're doing, is we're signing on behalf of the client as the administrator to the account. So the client approves all the paperwork. We do not send any executed forms out until we have a copy of that form with the term read and approved on the document and the client's signature. We are not here to make investments on your behalf. We're here to execute what you authorize for us. And then ultimately what the investment provider receives, what Jennifer receives, is a document that is signed by an authorized signatory of Advanta IRA. And we have an authorized signatory resolution we typically send with that. That's just a legal document that said these are the people representing Advanta IRA that are allowed to sign on behalf of this retirement account. And again, on the back end, we've made sure that clients approved us to even do that before we even get to that point.
Yeah, and this is where you all really shine. So as I mentioned at the very beginning of this call, it'll take me 3 weeks to get signatures on documents from my custodian because there's no one that I have as a personal representative that I can call. So I love that you all, again, give people a personal client or a assigned representative to represent them. So I know exactly who to reach out to and really help facilitate that deal. So appreciate that about you. There was a question from Jane. She wanted to make sure if she's over 60, is the amount that she can contribute the same as somebody over 50, or does it change at the age of 60?
The only threshold is 50. So once you reach 50, you get that extra catch-up limit, the extra bonus to your contribution limit. The only other thing that age really has a factor in is if you're in a tax deferred account, a traditional style account, there's what's called required minimum distribution age. And once you reach that age, which I believe as of right now is 74, you're no longer able to contribute into tax deferred accounts. And you also must start drawing out of that account based on, there's a table and a chart. It's based on your age, your life expectancy, and the total value of your account. So in theory, in that capacity, the IRS is trying to, with the best estimate or judgment of how long you're going to end up living, make sure you kind of end where that account's down to almost nothing potentially, or whatever's left in it, you hand off to beneficiaries and they're able to continue on, but they would have required minimum distribution necessary. The flip side of that is if you have a Roth account, there's no required minimum distribution and you can contribute into the plan for as long as you keep generating earned income. One other thing that I actually, before Jennifer asked that question, I wanted to throw out, with the people investing in the syndications that are setting up brand new accounts, just kind of another thing that we're able to facilitate. If the client gives us the kind of the authorization to be open and forthcoming and transparent with the investment provider, we can tell them through the process, hey, we're waiting on the money to come in, but the client's already approved the paperwork. Here's your signed documents. Let's lock this client into the deal. And we're going to get the money to you as soon as we possibly can. We're just waiting on it to even get to us. So that's another side that we facilitate within those 7 days. If, again, the client walks in and says, hey, I want to do this deal, and they have everything lined up, we're really getting things done within that first week in principle. And after that 7th day, that's when we can actually fund the transaction, so long as the money's here and the IRS rescission period's closed.
Any other questions from anybody?
Yeah, does anyone have any questions? You can, unmute or drop it in the chat.
Say hi, unmuted. I saw.
Yes, I have a question. Thank you, Corey. This is a great presentation. There's a lot of good information. My question is about the using Sidra for for a deal that you're a GP on. I know you say you can't be more than 50% in the deal or as a GP, and then you can't be involved on a day-to-day. I missed the part where you said about whether this is actually explicitly defined in the IRA document, or is it just the general recommendation for your company?
Yeah, no, I got your question perfect. So the IRS rule is that if you are a general partner with either 50% or more controlling stake on the GP side, or you are making day-to-day decisions, it is prohibited from using your retirement account as a limited partner. If those two criteria are not met, so you're a general partner and you don't have 50% or more, and you are also not making any day-to-day decisions, that is where there's no black and white rule. And we would effectively let that person make that investment, but implore them to get their own legal guidance or counsel, so that if they were ever audited in the future, they have some sort of legal leg or backing to stand on if they're ever challenged for that transaction and for holding that asset. But if you're 50% or more and in any capacity you make day-to-day decisions as a general partner, it is black and white. You should not be making that investment with your retirement account as a limited partner.
Perfect. Yeah, good to know. Thank you. I didn't know that, so that was very useful.
You're welcome. Of course.
Thanks.
That was a good question. Actually, that's a good question because that was good for me to know as well. Being on, potentially on GP side. Yeah.
I had learned that early on that if you're going to be a GP in a syndication, you just don't use your own IRA just for just for the safety of your own IRA. And that way it just keeps it really clean. And then, so I've used my IRA in other operator syndications. And those are my favorite because I'm 100% hands off and it's growing and, I can sleep well at night.
Yeah.
I see that very commonly for sure. Yeah, I mean, know, like, trust, right? You're building your know, like, trust triad. Well, if trusting someone to put your retirement dollars into their deal and in turn they're putting their retirement dollars into your deal, it kind of lends itself to both the networking side of the industry and also the let's all grow at the same time.
Yeah.
Corey, I have another question. We have, I think, 1 more minute, so I'm going to try to make it a quick question. I have a family member who is a W-2 earner. He is in his late 40s and he only has a 401k through his employer. He doesn't have anything self-directed. So just to clarify, he could still have his 401k through his employer and also have a self-directed and open a self-directed IRA.
Yes, and actually that is a great question for me to bring up a separate nuanced topic with the employer-sponsored plans that I failed to mention earlier. So thank you. You teed that up very well. You said it was cousin, right?
My family member, yeah.
Family member, okay. Yeah. Your family member can definitely set up a IRA account and contribute income into that plan. There's no restriction there. Just a general IRA or a Roth IRA are not tied to any employment. Anyone can have them. Anyone can have as multiple as they want. So that this family member can set up a traditional IRA with a managed company and also a self-directed IRA. And as long as they're only getting to the contribution limit, because it's a concurrent limit, so 3,000 here, 3,000 there, or 4,000 here, 2,000 there, that's perfectly fine. Separately, and this is kind of a really juicy tidbit at the end, I mentioned earlier previous employer plan, so a job that you've already left. Sometimes you're able to tap into your current employer-sponsored plan, but not all the time, and in a very case-by-case basis. What I'm describing is called the in-service rollover, where based on your employer and the company they run their retirement plan through, so the Fidelities, the Edward Jones, the Charles Schwabs of the world, they have a plan agreement that governs your retirement account, that 401k or whatever plan it is. And in that plan agreement, there's language that either does allow for in-service rollovers or does not allow for in-service rollovers. Most of the time, it does not, to be honest. Sometimes it does. And when it is, yes, you can do an in-service rollover, well, then what you're effectively able to do is break off a leg of your full 401k plan that you're still contributing to with your current employer and move that over to a self-direct, or really any other type of account for that matter, but it's used for self-direction for the majority of time. Because why would you take it out to then put it into other assets that it was already invested into while it was there? So that's basically the gist of that is in-service rollovers. I always facilitate those phone calls if a client's not sure how to ask it. That's something, as I alluded to, with like actually helping Allie set up an account. I'd be happy to help make that phone call, or if you're able to just take down those few words, in-service rollover, and know who to ask either in your benefits department or by calling the custodian that manages your employer-sponsored plan, it's a great way to tap into some additional resource there.
Okay, awesome. That's great. Thank you so much, Corey.
I have one last question. I was wanting to know, how does that minimum, because I mean, when you're employed, a W-2 employee, and you have a 401k plan with that corporation, and you have you're able to put in a whole lot more than $7,500 into that account.
Mhm.
Because of what you put in, what the company contribution is. Why is it that gets to do that way, yet they're capping? Do you have any idea why that happens?
Yeah, and is that Jane that's asking that question?
Yes,
Jane,
it is.
Jane,
I'm sorry.
No,
I
it's all
just got finished mowing, so I don't want to be on camera.
No, you're fine. I just wanted to make sure I was addressing you directly. Honestly, I don't have a specific answer to that question. I can give you some of the wheels that are turning in my head that answer it in my mind, but I can't tell you like this is the definitive answer to the question. First off, the contribution limits are different for an IRA account, an individual retirement arrangement account, and employer sponsored plan like a 401k or any of those other kind of acronyms, 403b, 457, TSP. So the contribution limits in themselves are structured and set up differently. There's not necessarily the required minimum distribution when you're contributing into an employer plan, whereas the IRA accounts, they have that required minimum distribution because right now, again, this is in my words, the IRS or the government wants to tax that money. Like you have it in a tax sheltered or tax deferred account. They want to get a hold of it and get their portion of that. So that is why towards the end of your natural life, I believe it used to be 70 and a half, then it bumped up to 72, now it's 74. They start the required minimum distribution process. Again, you can otherwise do that ahead of time by doing a Roth conversion, paying the taxes on that money so that it can grow still in your retirement account, completely tax-free. But aside from that, you know, the best guess I can say is that they're wanting to get their hands on the funds as to why the RMD even starts to take place. And then separately, the contribution limits, as you asked about, they're completely separate, as you mentioned, because it's an employer sponsored plan. So there's multiple components that go into that contribution limit. You making an employee salary deferral into the plan, and then the employer making a contribution match into the plan as well from their standpoint. There's also some ways to do even larger contributions into those types of plans, like a backdoor contribution, sometimes called a backdoor Roth or a mega Roth. I really am not going to get into those. We have other educational content on those specific options, but it's really ways to supercharge your retirement account and the money you're putting into these retirement accounts. I didn't cover the specific limits, but Jane mentioned it. With an IRA, 6,500, 7,500. With a 401k plan or specifically a solo K, if we're talking to real estate investors and talking to people getting into the entrepreneur type world, your contribution limit is upwards of 66 to the low 70,000. So if you maximize everything, if you maximize what you can contribute as an employee, what you can match as the self-directed, the self-employed individual on the entity side or the employer side, it's really tenfold what an IRA contribution limit is.
Okay, thank you.
You're welcome.
Thank you, Corey. I wanted we're at time, but I wanted to first thank you everyone for being here, at this time on a Thursday. So thank you. And Jennifer and Corey, thank you so much, of course, for your time and your expertise, your knowledge, your insight. I really appreciate it. And I know that I have a lot of people waiting on this recording, so they will be really appreciative of this information as well.
Well, thank you for putting it together, Allie, and thank you again, Corey, for your time and expertise.
Yeah, no, thank you both for coordinating this and Jennifer introducing me to Allie. As I said, I've had pretty much a lifelong professional passion at financial literacy and kind of just sharing some of the information and knowledge I've built for myself with whoever I can, younger than me, older than me, whoever can benefit from it, because I didn't come from a background where that was like in my life inherently. I had to seek it out. So I now just kind of have this kind of drive to be a beacon of things like this. So any chance I get to come speak and share what I've got, I'm happy to do so. Thank you very much for having me.
Yes, love that. Love that. Thank you, Corey. I'll be calling you for my setup.
Yeah, well, we'll set it up for sure. We can get that turned around really quick.
Yes, definitely. So thank you, everyone. Corey's information is here if you want to connect with him. And yeah, Jennifer, is there anything last words?
No,
Good.
just
Okay.
thank you. Thank you so much. And let's all go build wealth together.
Yes, absolutely.
Thank you, everyone. This was my first time being on a call like this. It's just like a conversation starter for me. I just wanted to learn, and it was wonderful learning from you guys. So knowledgeable. So thank you for sharing.
Yes, absolutely.
Thanks,
Good.
Michaela.
Yes,
Yeah.
everyone have a great evening.
Thank
Have a
you,
great
guys.
evening, everyone. Bye-bye.
Take care.
Yay.